Have you ever heard of a secret money trick that could help you pay off your mortgage in just 5 to 7 years, all without earning a single extra dollar? It sounds too good to be true, right? Well, that's the promise of a strategy called velocity banking. Today, we're going to dive deep into this controversial method. We'll break down exactly what it is, how it supposedly works, and most importantly, whether it's a financial masterstroke or just another clever scam waiting to trip you up. So, what is velocity banking? The core idea is surprisingly simple. Instead of using a traditional checking account for your day-to-day finances, you use a line of credit, like a home equity line of credit, or HELOC for short. The theory goes like this. You deposit your entire paycheck directly into the HELOC. This immediately pays down a chunk of the loan balance. Then, throughout the month, you pay all your bills and living expenses using that same HELOC, essentially reborrowing the money you need. Why would anyone do this? Proponents of velocity banking claim this method dramatically reduces the amount of interest you pay over the life of your loan, because a HELOC calculates interest daily. Every single day your paycheck sits in that account before you spend it, you re-reducing the principal balance that the interest is calculated on. Even for a few days or weeks, this can add up. The money you save on interest, they say, effectively becomes extra payments towards your principal. Over time, this velocity of money moving in and out of the line of credit accelerates your debt repayment, allowing you to pay off massive loans like your mortgage years ahead of schedule. Let's walk through a simplified example to make this clearer. Imagine you have a $50,000 HELOC balance with a 6% interest rate. The difference might seem small month to month, maybe just a few dozen dollars. But here's where the genius part is supposed to kick in. That interest saved is money that stays in your pocket, or rather, it stays as equity in your line of credit. This creates a positive cash flow, or a chunk that can be used to make an extra payment on another debt, like your primary mortgage. You use the HELOC to make a large lump sum payment on your mortgage principal. Then you repeat the cycle. Use your paycheck to pay down the HELOC, live off the HELOC, save on interest, and use those savings to attack the next chunk of mortgage debt. By repeating this process, you can allegedly create a snowball effect that demolishes your mortgage in record time. It sounds brilliant, doesn't it? A financial hack that lets you beat the banks at their own game using their own products. And for some people, under very specific circumstances, it can work. The people who find success with velocity banking are usually incredibly disciplined, financially organized, and have a stable, predictable income that significantly exceeds their expenses. They treat their line of credit like a high-stakes checking account and never, ever overspend. They track every penny and stick to the plan with military precision. For these individuals, the math can, in fact, check out. However, and this is a huge however, there are some serious risks and downsides that the loudest advocates of velocity banking often gloss over or completely ignore. This is where we get into the scam side of the argument. First and foremost, this strategy requires a tremendous amount of self-discipline. Most of us use the limits on our checking accounts as a natural brake on our spending. When the money is gone, it's gone. But when you're living off a line of credit with a limit of, say, $100,000, it becomes dangerously easy to overspend. A small emergency, a little impulse buy, it all just gets added to the loan balance. Before you know it, you haven't just spent your monthly income, you've dug yourself deeper into debt. The second major risk is interest rates. Most HLOCs have variable interest rates. This means the rate can go up at any time. When you start velocity banking, the rate might be a low 5%. But what happens if the market changes and your rate jumps to 8% or 10% or even higher? Suddenly, the small amount of interest you were saving disappears. In fact, you could end up paying far more in interest than you would have with your original fixed-rate mortgage. You've effectively traded a stable, predictable loan for a volatile, risky one. All your careful planning could be wiped out by a single decision from the central bank. Another point to consider is the complexity. Velocity banking isn't a set-it-and-forget-it strategy. It requires constant monitoring and management. You're not just paying bills. You're actively managing a large debt facility as your primary financial tool. This can be stressful and time-consuming. It's also important to remember who is often promoting this strategy. People selling expensive courses, coaching, or software that promise to teach you the secrets of velocity banking. They often showcase best-case scenarios and downplay the very real risks, because their goal is to sell you their product, not necessarily to ensure your financial well-being. So, is velocity banking a scam or genius? The truth, as is often the case, lies somewhere in the middle. It's not an outright scam in the sense that the underlying mechanics are based on real financial principles. Using a line of credit to manage cash flow and reduce daily interest charges is a legitimate concept. However, it's a high-risk, high-discipline strategy that is presented as a magical solution for everyone, and that's where it becomes misleading and dangerous. It's like being told you can get to work faster by riding a unicycle on a tightrope. Is it possible? Yes. Is it a good idea for the average person? Absolutely not. For the vast majority of people, there are safer, simpler, and more effective ways to pay off a mortgage early. The most straightforward method: make extra payments. Even paying an extra 1/12 of your mortgage payment each month, effectively making one extra payment per year, can shave years off your loan and save you tens of thousands in interest. Setting up bi-weekly payments can have a similar effect. These methods are simple, carry no extra risk, and don't require you to turn your entire financial life upside down. In conclusion, while the theory behind velocity banking is intriguing, the practical application is fraught with peril for most people. It demands a level of financial discipline that few possess and exposes you to significant interest rate risk. Instead of chasing a complex secret strategy, your time and energy are much better spent focusing on the fundamentals. Creating a budget, increasing your income, reducing your expenses, and consistently applying any extra cash flow directly to your mortgage principal. That's the real, time-tested secret to achieving financial freedom. It might not be as flashy as velocity banking, but it's a whole lot smarter and safer. Thanks for watching today. What are your thoughts on velocity banking? Have you tried it, or do you think it's too risky? Let me know in the comments below. And if you found this video helpful, be sure to hit that like button and subscribe for more straightforward financial advice. See you in the next one.